So today I wanted to talk about building wealth. And building wealth is one of the most important things you'll do in your life. And not for the sake of it, but for the fact that we live in a capitalistic society and you need money to survive. And so what I wanted to talk about was really the simplest way that I know of. As you can probably tell when you search this on YouTube, there are thousands of strategies showing you a variety of different ways, and all of them have their own pros and cons. The strategy I'm going to talk about doesn't require any specialized knowledge. So it doesn't require you to be a marketing genius. It doesn't require you to be super outgoing or have any special skill sets that are difficult to build, like programming or knowledge about a deep industry like real estate. So this is meant to be accessible to the average person. If you think you're special and you have those special skill sets, then go watch another video. But this is for the average person who's just working their job and may have some entrepreneurship tendencies, but ultimately this is the easiest way that I know how. So I will caveat this with the fact that I'm not 100% where I want to be. I'm probably what you would call lean fire. I have enough investment income to cover my baseline expenses and a vacation once or twice a year. But there's still room for me to grow, and I intend to kind of boost it a little bit just to mitigate the risk of the crazy world we find ourselves in. So the most important thing to do right out of the gate is to invest every dollar you do not need to survive. And what do I mean by that? I mean every dollar not going towards rent, food, transportation, or your job. That's it. Every other dollar, especially at the beginning, you want to be putting away in some retirement account. So depending on your employer, you may have access to certain retirement benefits. One of the best benefits out there is really the 401k match. So for every dollar you put in, you get a tax deduction, and your employer will put in another dollar. So you've essentially doubled your money and then some because you're getting a tax deduction. So this is the first thing you'll want to do. And many employers smartly auto-enroll its new employees into the match just to max it. But if not, this is definitely something you want to prioritize immediately. So why is it important to start this immediately? Well, as soon as you put the dollar in, it's earning. And you want your dollars to be earning money for you because they will work harder than you can. Your dollar works all day, 24 hours a day, while you're sleeping, while you're working, while you're watching TV, they're working for you. That's something you can't do. So you want to get them to work as soon as possible so that you can benefit from that as you grow older. So if you're starting a new job and you haven't set up your 401k match, stop this video, call or email your HR team, and get this set up immediately. You want to prioritize this because you're starting a new job and you're going to be doing all types of new things. And this is going to just go to the back of the line as you're trying to focus on how to survive in your new job. So do this immediately if you can. So what if your employer doesn't have a match, or you've already contributed enough money to get the match and you still have money left over? Well, the next thing you want to do is the Roth IRA. So the way the Roth IRA works is every dollar you put in grows tax-free for the rest of your life. So if you put $1,000 in and that $1,000 becomes $15,000 over the course of 40 years, you don't have to pay any taxes on any of those gains. But you do lose out on the tax deduction. So in the 401k, if you put $1 in today, you get a tax reduction for today's tax year. There are pros and cons to doing deductible versus the Roth. And generally, if you're in a high tax bracket now, the deductible is probably the better option. But if you think you're going to be in a higher tax bracket in the future, then maybe the Roth's the better option. I do both because I have no idea how the tax laws will be in the future. And I want the flexibility to decide, whether I'm going to pull after-tax dollars that have already been shielded, or if I want to pull the deductible. It gives me the flexibility I need to plan my distributions in the future. So now that you've done your Roth and now that you've done your 401k match, this is a key inflection point. What do you want now? And what you want now may depend on your current circumstances. Do you have student loan debt? Do you have medical debt, credit card debt? Do you want to buy a house? Can you even buy a house where you live? Or are you ready to start taking your wealth building to the next level? So if you have credit card debt, you'll want to pay that off immediately. The interest rate on those are sometimes 15 to 20%. And it is incredibly difficult to dig yourself out of that. So focus on that 100%. If you have medical debt, you might consider calling the hospital and trying to negotiate something. A lot of them are pretty flexible just because the default rate on those is pretty high. But you'll have to pay that off next. And then if you have student loan debt, you can't discharge those in bankruptcy. So hopefully you got a good career out of that debt and you can pay it off. Depending on the interest rate, maybe you don't need to prioritize it immediately. But the fact that you can't get rid of it during bankruptcy, I think it's worth paying off for peace of mind in case you find yourself in a bad situation in the future. But hopefully you've paid off your debts, or better yet, you never had any debts to begin with. You might be tempted to buy some real estate. Well, honestly, the feasibility of buying real estate in many cities is very low. It really depends on your local market, whether you can or not. I live in Houston, Texas, and it's June 2021, and the prices are insane right now. The average college graduate, I think, would struggle to save up enough money for the down payment in any short-term capacity. But if you are really dead set on owning property, you might want to talk to a realtor and get an idea for what that range would be for a starter home. And buying a house is a complex transaction, and maybe I'll do another video on what to look for when buying a house. But at least starting to save up for the down payment might be the logical next step for you if buying real estate is feasible in your local market. With the real estate analysis out of the way, the next thing you'll want to do is max your 401k as soon as you're able to. If you're not in a position to max your 401k, then you'll need to invest in your skills to make enough money so that you can afford to max your 401k. So to summarize, first step, contribute to get your employer match. Second step, contribute to a Roth IRA. Third step, pay off any debts that you have, and then maybe start saving up for real estate if you really want it. And then the last step is maxing your 401k. That's all you need. I think most people would have enough money in retirement if they just did those things. So it's easy for me to say you'll have enough money in retirement, but I'm actually going to show you. So I have an Excel document that's going to walk through year by year with some baseline assumptions to show you kind of the power of compounding growth. So here's an example of someone who started at 22, maxing out their 401k, getting a $2,000 match from their employer, and maxing out their Roth IRA. Assuming that you're going to get an average return of 5%, which is way below average, but I'm being conservative here just to illustrate a point. By the time they're 42, they're going to have over $1 million doing nothing but just making the 401k contribution max and maxing the Roth IRA. And this is also assuming no increases to the contribution limits, which they do increase it over time. So that's all you really need to get to $1 million by 42. And if you look even further, I mean, by 65, there's $4.3 million here. So the average person, I think, would be able to retire off of this. So if nothing else, just do the retirement accounts. So the whole point of that was just to show you how boring it could be to generate $1 million. There was no crazy entrepreneurship happening. There was no developing apps. There wasn't picking the right stock or picking the right cryptocurrency. It was all just putting it into your retirement accounts, not thinking about it, and moving on with your life and doing the things that you care about. So after you've maxed out all your retirement accounts, the next step is to open up a taxable brokerage. I do mine with Vanguard. Fidelity is also really good. You'll want to open one of those up and contribute every dollar that you do not need to survive, and protect it from yourself and put it in there so that it can grow. And your future self will thank you because it'll grow faster than you think, and there are no limits. So as your career progresses and you make more money, you may find yourself with a taxable account that's larger than your 401k. So earlier we were talking about kind of the sequence of where to put your money, but I didn't necessarily tell you what to actually invest in. And there's a lot of reasons for that, but the biggest one being I'm not a financial advisor, and this is not financial advice. This is for entertainment purposes only. But ultimately, it really depends on your unique situation, what investments make the most sense. For the sake of giving you guys something actionable to work from, I'm just going to come up with a couple of archetypes. And these are theoretical people and what they probably should invest in based off their specific circumstances. The first archetype is that highly compensated employee. Think of someone like a doctor or a software engineer or someone with a very time-consuming job that maybe they enjoy, but they don't have any time to do anything like a side hustle or set up a side business. This could also be someone in finance or accounting who's just got crazy hours on their plate and they really don't have the time to monitor investments that proactively. In that case, I think the best investment is really index funds. And from Vanguard, there's VTSAX, and the ETF version of that is VOO. And what those are broad index funds. I think VTSAX is probably the total stock, and I think VFIAX, obviously Google these, is the S&P 500 index fund. Those have historically done around 10%. I don't think that's adjusted for inflation, so definitely do your own research. But I think for those types of individuals, they should just be, plugging away and in each of their retirement accounts, only invest in those index funds and don't touch it, never sell, hold it forever, and don't watch it day to day. The second archetype is the medium to highly compensated employee with some free time, or maybe they're not super passionate about their job and they want to start building something on the side that they control 100%. For these people, maybe it's kind of a split. 50% of whatever money you're able to save goes into index funds, and then the other percentage can go into something called dry powder. And dry powder is just a finance term for money that's allocated for future deals. So think of this as like money ready to go whenever you find an opportunity. The only reason to do this is if you're actively searching for opportunities. If you're a real estate investor, maybe you're looking for foreclosures, or you're looking for distressed housing. You have this money set aside so that you can buy or put a down payment on a property very quickly. And a lot of these opportunity-based investments are very, very unique to the local market, or there's so many nuances that you have to be really paying attention to identify these opportunities. So a good part of that is having the resources available to take advantage of those opportunities. And I used to do real estate a while back, so I know the pros and cons to having too much dry powder, because there's an opportunity cost with every dollar you put on the sidelines. So it's just something to be cognizant of, and whatever it is you're trying to invest in, make sure you understand it very well. The third archetype is medium to low income employees, and there's no easy way to say this, but the main thing these people need to invest in is their skill sets. And this is not necessarily college. This is creating a set of skills that can earn you more money than $50,000 a year. You need at least $50,000 to $60,000 a year to even dream of building wealth. If you're in a position where you just don't have enough money to even start contributing to a retirement account, you need to invest in your skills. And this could be going to a trade school, becoming an apprentice, learning how to develop a marketable skill. If you have the aptitude for it, learning how to code so that you can build a portfolio and work in automation. If you're going to go back to college, you really need to think hard about what skills you're going to derive from that college experience. Because one of the main downfalls of postponing your adulthood and going into college is the amount of debt that decision is going to generate. So definitely focus on what skills can I create for myself that are marketable versus, just blindly going to school and getting into more debt. one of the most important things to make sure you're doing as you progress through your career and as you expand your skill stack is to remember to have your contributions, your investment contributions, increase lockstep with your raises. I think a lot of people sometimes forget to do this, and they're contributing what they were when they first started, and they're making maybe double of what they were when they first started. You want to keep on increasing those so that you can leverage your higher income and also mitigate the lifestyle inflation that may come with more money that you may be making. It's just something to automate as soon as possible so that you don't even have to think about it. Because as soon as it hits your bank account, that money becomes real and it becomes very tempting to spend it. So keep it away from you as much as you can, and your future self will wake up and there will be millions of dollars at their disposal to use however they want. The beauty of this strategy is it's almost like a one-time setup. You decide what your spending is going to be, and you dump everything else into your retirement accounts, and then anything that falls in that spending bucket, you can do whatever you want with it. You can travel as much as you want. You can buy as much as you want within that boundary that you've set for yourself. And you might realize that you don't really need to be spending all that much money to be happy. And all the money that you've set aside working for you, it's going to eventually produce that minimal expenses faster than you'd expect. If you've put everything away and if you've maxed everything, it will grow. Even if you do like your job, it'll give you the confidence to negotiate your raises more. Once you've set up that foundation, the sky's the limit on how you want to design your life. So maybe you guys were expecting something less obvious, but honestly, building wealth is not a complicated endeavor. It's so simple, and I think the media, the news, politicians, they make it seem so complicated and assign some weird attributes to it, like you're a good person if you're able to build wealth, or you're stupid if you can't do it. But honestly, it's really about designing a system and sticking to it and not trying to outsmart the system. You gotta keep it simple, stupid. It's the KISS method of things. The more complicated you make something, the more breakpoints there are in the system. So make it as simple as possible. Don't try to over-engineer it. Don't try to FOMO into some fad investment because Yahoo News says that Dogecoin's gonna double if Elon Musk tweets about it again. All of that is a distraction. This won't get you rich overnight, but I think the likelihood of it getting you rich is a lot higher than a lot of what the FOMO economy is trying to get you to buy. So thanks for watching. Hope to see you next time.